Good afternoon, investors. You are now on KleverStock with me, Madhaveshwari, and I will be serving you the midday roundup with the latest market updates from this morning up until now. Kicking it off with the Bursa Malaysia updates, the Malaysian stock market showed signs of stability on Wednesday morning, even as global markets struggled with news of conflict between the US, Israel, and Iran. While the FBMK LCI dipped slightly by 3.14 points to 1,708.61, it remained more resilient than many neighboring markets, such as Japan's Nikkei, which fell over 2%. Market analysts from APAC Securities suggest that while traders are currently cautious due to uncertainty, the long-term upward trend for Malaysian stocks remain healthy. They view the current dip as a temporary correction rather than a major crash. The firm noted markets tend to fear uncertainty more than the conflict itself, and such pullbacks may offer selective entry opportunities for longer-term investors, adding that the overall market structure is still strong. Energy stocks were the standout performers of the session as concerns over global oil supplies grew. Companies like Heng Yuan Refining saw significant jumps, while others like Hibiscus Petroleum and Bumi Armada also trended upward. Despite more stocks falling than rising overall, the steady performance of the main index suggests that local investors are holding their ground. Moving on to our local currency and foreign exchange. The Malaysian ringgit saw a fractional gain against the US dollar at the start of Wednesday's trading session, though analysts warn that the local currency remains vulnerable in the intensifying geopolitical risks. Market participants are increasingly gravitating toward the greenback as a defensive asset, spurred by uncertainties surrounding global energy supply chains. As of 8 a.m., the ringgit was quoted at 3.9390 or 3.9535 against the US dollar, a slight uptick from Tuesday's closing rate of 3.9440 or 3.9495. Despite this minor recovery, the underlying sentiment remains cautious as international attention shifts towards potential disruptions in the Strait of Hormuz. Dr. Muhammad Nizam Abdul Rashid, chief economist at Bank Muamalat Malaysia Berhad, noted that the US dollar index continues its upward trajectory. He pointed out that major global players are reacting to the heightened stakes in the Middle East, with China calling for protection of transit vessels and the US administration offering assurances regarding tanker escorts to maintain the follow of their energy experts. Dr. Muhammad Nizam told Bernama the ringgit closed lower against the greenback by 0.53% to 3.9446 yesterday. In light of the risk aversion, we foresee the ringgit to continue to remain weak as traders seek refuge in the US dollar, he said. Performance against other major global currency was largely uneven. At the opening bell, the ringgit managed to gain ground against the Japanese yen, moving to 2.4964 or 2.5059. And showed a marginal improvement against the euro at 4.5736 or 4.5904. However, it weakened against the British pound, which rose to 5.2590 or 5.2783. Within the regional landscape, the ringgit struggled to find its footing against most ASEAN counterparts. It edged lower against the Philippine peso and the Thai baht, while remaining relatively stagnant against the Indonesian rupiah. A bright spot in regional trading was seen against the Singapore dollar, where the ringgit improved to 3.0841 or 3.0959 from its previous close. Now for some local economic news. Malaysians should prepare for a gradual increase in the cost of living, particularly in the food and transport sectors, as geopolitical instability in the Middle East begins to impact global logistics and energy prices. While headline inflation currently sits at a modest 1.6%, experts suggest it could drift toward 2.2% by end of the year. Mohammad Siddiq Jantan, Director of Investment Strategy at IPPFA Sindarian Berhad, explained that transport services usually feel the impact of global conflict faced due to rapid adjustments in fuel and shipping costs. Food prices typically follow shortly after as the increased cost of fertilizer, animal feed and distribution move through the supply chain. Siddiq said, we expect inflation to drift towards 2.2% by year-end, largely reflecting mild but sustained pressures in food and transport-related services. He also noted that while oil prices under $90 per barrel keep inflation moderate, a stronger ringgit trading between 3.90 and 4.00 is essential to contain the cost of imported goods. The Malaysian government has signalled its commitment to protecting consumers. Prime Minister Dato Sri Anwar Ibrahim recently stated that the government will make every effort to maintain the RON 95 petrol price at RM1.99 per litre despite the market uncertainty. However, economists warn that this subsidy becomes structurally burdensome if Brent crude climbs towards $90 or $100 per barrel for an extended period. Regarding monetary policy, Bank Negara Malaysia is expected to keep the overnight policy rate steady at 2.75%. Siddiq suggested that cutting rates prematurely during such uncertainty could weaken the ringgit and worsen inflation. Professor Geoffrey Williams shared this cautious outlook, noting that Malaysia's trade position actually benefits from higher oil prices, which helps balance the risks. Williams observed that inflation remains low, the ringgit is relatively stronger and import prices are contained. He added that the most of small and medium enterprises remain shielded as they focus on domestic rather than external markets. Experts advise households to review their spending habits and build small cash buffers to handle short-term price fluctuations. Rather than a sudden spike in utility bills, the primary risk for the average Malaysian will likely manifest gradually in delivery fees, processed foods and dining out. Continuing with corporate news updates. Malaysia's corporate sector ended 2025 on a high note, with many companies reporting significant profit growth. Bank Muamalat Chief Economist Muhammad Nizam Abdul Rashid noted the consumer, energy and tech sectors performed particularly well. This success was fueled by a strong 6.3% economic growth rate, high employment and a powerful ringgit. Nizam explained conducive macroeconomic environments such as full employment, accommodative monetary policies, expansionary fiscal policies and the strong ringgit are some of the factors. He believes that as long as the local economy stays resilient, corporate profits will continue to climb throughout 2026. Dato Thomas Yong of Fortress Capital added that while the overall trend was positive, it was a constructive albeit with some nuances season. Major banks like Maybank and RHB saw steady growth and construction firms stayed busy with new data center projects. However, it wasn't good news for everyone. The plantation and petrochemical sectors struggled, with some major players reporting heavy losses due to weak global demand. Looking ahead, analysts from UOB Kay Hian Research suggest investors stay risk-on but quality-focused. They also expect the market to remain stable thanks to government policies and the recovering ringgit. While global tension remain a concern, experts favor domestic sectors like healthcare, utilities and high-yield stocks to lead the way in the coming months. We will now take a short break, but don't go away. We will return shortly with corporate news developments. Welcome back to the Midday Roundup. Let's continue with some market news updates. Asian stocks market took a major hit on Wednesday as investors scrambled to sell off shares in chip makers and gold. The sell-off was driven by growing fears that the widening war in the Middle East could lead to an energy shock, driving up inflation and forcing central banks to delay interest rate cuts. South Korea was the hardest hit with its market diving 4%, bringing its two-day losses to over 11%. This massive drop also pushed the South Korean won to its lowest value in 17 years. Japan's Nikkei index also struggled, falling 2.5% as both nations, which rely heavily on imported energy, braced for higher costs. Damien Boy, a strategist at Wilson Asset Management, noted that the situation is becoming more complex. He said it does look like conflict is going to go a little bit longer than what people thought initially, adding that attacks on oil infrastructure and forcing everyone to rethink how long these high prices will last. While oil prices settled at $81.40 a barrel after a 12% jump this week, they came off their highest peaks after US President Donald Trump suggested the Navy might escort oil tankers through the Strait of Hormuz. Despite this, the volatility caused gold to drop 4.5% as traders crashed out of winning bets to cover losses in other areas. The ripple effects are being felt globally. In Europe, gas prices surged 65% in just 2 days, while in the US, investors are worried that high energy costs will seep into the broader economy. Up next, we have some business updates. At the Mobile World Congress 2026 in Barcelona, the tech industry is racing to integrate artificial intelligence while navigating a historic tsunami like memory chip shortage. Major telecom players like Nokia, Nvidia and Qualcomm have announced massive 6G alliances, yet the event remains under the shadow of the Middle East conflict, which has delayed executives and spiked the cost of essential materials like gold and copper. The most urgent concerns at the summit is an AI-driven memory crunch as data center giants like Google and Meta hoard chips for their own AI projects. Smartphones makers are being left behind. Analysts predict this will cause global phone sales to drop by a record 13% this year, with budget-friendly devices being hit at the hardest as manufacturers pivot to expensive premium models to survive. Ben Wood, an analyst at CCS Insight, warned this is not a temporary squeeze, noting that the shortage affects everything from watches and laptops. Qualcomm CEO Cristiano Amon directly blamed these supply constraints for the shrinking mobile market. On the show floor, innovation continues despite the crisis. Honor and Motorola debuted new book-style foldables to challenge Samsung and Apple, with Honor even showcasing a robot phone that uses a mechanical arm to track users. Meanwhile, Nvidia and Nokia are moving toward AI-native networks to improve efficiency and reduce the need for constant hardware upgrades. As the industry looks to an AI-first future, the immediate challenges remain whether new partnership can overcome the reality of strained supply chains and rising global tensions. Finally, wrapping up, we have major corporate developments and deals across Malaysia. Malaysia Marine and Heavy Engineering secured a 4-year offshore works contract in Sarawak from Thailand's PTTEP. Telecom Malaysia confirmed it has legally ended its 5G access agreement with Digital Nasional Berhad despite DNB's objections. Gadang Holdings plans to buy 11.2 acres of freehold land in Johor Bahru for 75.5 million ringgit. Duo Pharma Biotech Lembaga Tabung Haji is now a substantial shareholder after increasing its stake to 5.05%. MNRB Holdings received Bank Negara's approval to begin talks for the sale of its Islamic issuance Am Takaful Ikhlas. Chapat Wawasan Group selling its 40% stake in Cash Horse and Debrian Burhat to Thima Resources for 31.6 million ringgit. Well, that's a wrap for Midday Roundup with me, Madhaveshwari, on KleverStock. Thank you for choosing us investors. Stay tuned for our upcoming live stream programs.